In this video, traders, I want to examine the pros and cons of trading the open. Stay tuned. Hey guys, warm welcome to you. So I've done a few videos on this before talking about the open because it's the most active time of the day and many traders like to focus on the open. So it's not always rosy though, and I think there's some downsides to it and some upsides to trading at the open. So let's discuss those now in this brief video. So when I talk about the open, I'm talking about the cash open, regular trading hours open. Let's just say you're trading the S&P 500, NASDAQ, Dow, DAX, etc. These guys trade 24/5 or almost 24/5, and you can trade them anytime, but the open is when that cash session is open. So there's much more volatility. If you're trading US stock, there's a pre and post market, of course, but it's when the bell goes. So it's that definite time. It's like bang, off we go, massive liquidity coming in, massive volume coming in, opportunity. So a lot of traders focus on that because we have a volatile scenario. Lots of time there's volatility. It's the first time people get to interact in the options market for some of this stuff. It's the first time that they can execute some size, reasonable size. There's a lot of things that are happening, that are going on. And so we get a lot of volatility. And when there's news and it's digested the news, there's lots of action and stuff going on. So as traders, as active short-term traders, we want to capitalize on that inefficiency. And the open seems a great time to do it, right? And that's true. You know, under certain conditions, that offers beautiful opportunities because the open, I say the open, like the first 15 minutes, let's say, and then it gets flexible. Some people say it's first 10, 30 minutes, whatever. Very often, the higher the lower the day is put in. So it's a reason to get involved in that and say, hey, I'm going to get involved in the open because actually I want to get long on this dip, etc., etc. And, you know, historically, we've noticed that the highs and lows are put in the first 15 minutes. Great. And so you can often get the very best prices if you get involved in that. Best prices there. Opening order flow. So the opening order flow is essentially when you've got these market at open orders coming in that create these imbalances. And so very often we see candles whipping one way, coming back the other, driving lower 15 minutes, then catching a bid. There's these inefficiencies that can be capitalized on purely because liquidity is slightly lower. Everyone's like literally the starting gun's gone off and everyone's trading. Algos are trading, hedge funds are trading, retail traders are trading. Everyone's getting involved in the thick of it, and it's just a kind of melee of orders. And so you are going to get kind of these inefficiencies and swings back and forth that you can capitalize on a trader. So that's why traders like to trade the open. You know, with a very specific strategy at the open, you can do well. But let's look at the flip side. So it's not all rosy and milk and honey and profits and great to trade, because the open can be your worst enemy as a trader. And really, talk about some of these in just a moment, but it's when you don't have a defined way to trade the open that these tend to creep in. So you can have whippy action. In other words, yes, you might get these inefficiencies and market swinging, but it might be up and down and up and down and all over the place, as opposed to, you know, perhaps an exhaustion move lower that just flushes, signals a nice flush, then pops back up and fills the gap. That would be kind of a nice tradable move. When it's whipping backwards and forth, should I say, and you can't predict it, or it's harder to predict, you're in a difficult position because you're getting stopped out. It's this and that, the other. And so, you know, the whippy action can just become your nemesis because you get stopped out, you try again, you get stopped out, try again. And then what happens, it can upset the day because you can be down on the day, you can have your max loss hit the day. All these things can happen that really, really ruin the day and potentially put you on tilt. Because think about this, how many times are you prepared for the open, or you've had the weekend, like the bell goes, you're like, right, I'm ready to go, I'm prepared mentally, I've done prep, I've done this, done that, done lots of homework, and your first trade's a loser, your second trade's a loser. It's just such a smack in the face, and it just feels awful. And this is why sometimes trading the open is just, you know, even the profit potential that's there, sometimes it's worth avoiding just purely because of the possibility of it putting you in such a horrible position mentally. You know, if you trade that first 5 minutes, 10 minutes, 15 minutes, and you're offside, you're battling and this, that, the other, it's like it's ruined the whole day, potentially the whole week. And so the upside is, okay, make some money and capitalize on this, but the downside is that I feel awful, I'm on the back foot, I feel like I've got to catch myself back up, it's going to take me a day to recover that. It might not be worth, that deal might not be worth taking. It might be better to be more structured and calm and say, okay, I'm going to let the market do its thing. I'm going to get a read for it. One of the things you struggle sometimes the open is getting a read for the rhythm. Yes, you might see these swings and there might be some opportunities to capture it, but hey, what's the real rhythm of this market? Is it kind of range expansion? Is it quiet? Is it this, is that, the other? sitting back and sitting on your hands for the first 15 minutes or so can give you that perspective that you wouldn't otherwise get if you were straight in the first 5 minutes. Trading. Sitting back, observing, saying, hey, this is my idea, this is my theme, I think I want to get involved in this. Where's it going? How's it trading? What's the rhythm? It seems a bit quiet, maybe I need to wait for another hour or so. Hey, it's active, this is my level, one more little push lower after the first 50 minutes, I'll take that. This kind of stuff. So it helps you be less reactive and more predictive, more planning the trade a little bit better, because the open can seduce you with all these movements, just getting in, because you see quick movement, you go, I want profit, I want profit, I want profit. We're traders, right? We see movement, we go profit, ding, ding, ding. In actual fact, it's that structured, careful consideration saying, okay, it's moving, let that fight itself out, let me find where the highest probability way to get into this trade is, and then position for that. It could be the next 5 minutes, 30 minutes, hour, whatever it may be. So think of that, consider that. Say, hey, there are pros to getting involved with the open, the volatility, the action, the spice, all that other stuff, but it can come at a price. I think the biggest consequence is that you could upset the day and have tilt potential. And the way to think about this is to say, okay, if you trade the open, forget about the glamour of it and the excitement and seeing other traders doing well at the open. Just look at your P&L. And any journaling software will do this. If not, you can stick it in Excel and go, hey, how many times in the first 15 minutes, is the first 15 minutes profitable for me? Just a number. And just go, right, no, it's not. Okay, is that because there's one or two trades that have ruined the net P&L? If that's the case, can those be eliminated? How would that affect us? If you took out one awful day, for example, just got caught, a gap lower or a halt or something silly, if you took that out, what would it look like? And if it's still negative expectancy, then you just fixed a massive chunk of your trading. You go, hey, I am not going to trade for the first 10 minutes. I'm going to sit back and observe. And the little voice inside you going, yes, but you're going to miss trades. You're going to miss trades. You're going to miss all that money. But if you come back to it, it doesn't have to be how you're going to trade forever. But if doing this now, taking a step back and being more thoughtful and say, hey, the first 10 minutes for me is to assess, is to adapt, is to adjust, is to get a feel. When you have that, all of a sudden, a weight comes off your shoulders. You're there to observe, you're there to write notes, you're there to structure, you're there to position. And then the next trade has a higher probability of success. So not only do you kind of get rid of all the losing trades at the open, but the subsequent trades have a higher probability of working because you're more prepared. You're not trading on tilt. Your mind's not screwed up. You're not frustrated. And so it has a double positive impact. Now, that's not for everyone. Some people trade the open, do very well at it. But if you're not, be objective, assess it clearly, be honest, be brutal and say, I'm not very good at the open yet. However, I'm going to step back, I want to improve my trading, I'm going to come back, revisit that with specific ideas at some point in the future. So trading the open, guys, can be very lucrative if you've got a well-defined strategy under certain conditions, certain ways, certain plays, certain vehicles, certain scenarios, but it can also be really, really bad idea. Take care, see you next one, get your risk managed. Bye-bye.